Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside, like Riot Blockchain before it shot up 10,000%, Digital Turbine before it shot up 789%, and Overstock before it shot up over 1,000%. This power gauge comes from the legendary Mark Chaikin. And right now you can get a free in-depth look at how his power gauge system works. A way to type in any of the 4,000 different tickers and see exactly where the stock is most likely to go next and in any type of market. Simply go to powergaugetrial.com for your free look. Again, that's powergaugetrial.com for your free look. All right, let's get to our segment today. Hi, this is Daniela Cambone. Welcome back to the Daniela Cambone Show and our Outlook 2023 coverage.
I've never seen a decline that we're looking at now.
People are being laid off. Everything costs more. The interest cost of borrowing for anything is going higher and higher. And we are slowly grinding towards a position where something that's very weak cracks.
We're much higher than 6.5% inflation. It's not even close. We have put ourselves in a very dangerous position, and not to mention that with the food shortage impending and with the Federal Reserve raising rates into a recession, which is unprecedented, we're going to see that we're not going to have as much food, and the food shortage is going to grow, not decline.
Inflation is going to come down fast. There's even some danger of deflation and a major U.S. recession in 2023, and no one's ready for that. I mean, people talk about recession, but it's going to be worse than they think.
So let's put everything in context for the folks, because I'd like to have them leave an interview with some tools of, what do I do given the environment,
yes, please.
Right? And the last time you were on, again, was, peak inflation. You said, own gold, own oil, stockpile cash. Now that, like I said, inflation is cooling, we're going to see less tightening for the moment. What do we do?
Gold, I think, remains number one of precious metals in general. And then within the market, equities, my hunch is to have healthcare as sort of a major overweight, both at the defensive end, big names like Merck or Amgen, and United Healthcare, as well as speculative securities. And I would just own the XBI, which is the biotech ETF that captures a broad swath of small and mid-cap companies that are on the mend.
Well, gold hasn't done anything for over a decade, Danielle, and the way I learned it from my heroes was that the bigger the base, the higher in space. And, when something does nothing for so long, you've got a lot of frustration. You've got people throwing in the towel. You had your historic inflation print, something we hadn't seen in 40, 50 years, and gold went down. For me, that's just beautiful. That's poetic. When, all these conspiracy theorists are waiting for this historic inflation print, it finally comes and gold falls. I think that narrative was finally put to bed. You had these longtime gold bugs just say, just throw in the towel, nothing's ever going to work. And that's when it starts working.
Interesting.
I think this is really just the beginning. And if we've learned anything about gold, when any asset class, when it's in a bull market, it's in a strong uptrend, it doesn't just do well on an absolute basis. It also tends to outperform its alternatives. And that's precisely what we've been seeing. And what we also know is that trends in gold don't just last for a couple of months or a couple of quarters or even a couple of years. Historically, we're talking about decade-long trends. So, if we're just getting started, we might be in the second inning, maybe.
When you look at the overall picture, the correlations work over time, but what is the right correlation? And we don't have that number. Gold itself, we may need gold as a currency. The fraudulent fiat currency market, which is controlled by the central banking system around the globe, continues to be backed by nothing. And of course, there's starting to be some fear that there's not going to be money use. We're seeing some people switch away from US dollars. So there's a lot of issues out there that could make gold and silver needed as a currency once again. And they look very strong, and they certainly look like they're going to push up towards, not silver so far, because silver's got much longer to go. But I think gold certainly prints new highs in 2023.
To us, gold is the number one safe haven asset. When gold went down into the 1600s a few months ago, we said this is the bottom. It's going up from now. And now it's been hitting, several month highs. Again, when they go digital, gold is going to go through the roof, because that's going to be the only real currency that's going to be accepted to pay, to transfer. Because they're going to do away with all the paper money. Again, the whole world has gone AI. It's a whole different world. It's a whole different world. And you know what? The biggest news now that's being watched is TikTok. That's not news. That's like beep, beep, bop, bop, bop. That's where it's all going. And so what we're saying is to protect yourself.
Is there anything in the S&P that you like, or a sector that you're eyeing that you'd be in?
I think the energy sector, look, hedge funds are placing some pretty big bets on energy moving forward. Now, I'm not saying that we should mimic hedge funds, but I happen to agree that with them here. I think energy prices are going much higher moving forward. I'm not saying if people go out here and buy an energy company or an exchange-traded fund that tracks energy, that they're going to start making money tomorrow. But again, understanding how this is going to play out moving forward, I think commodities and having exposure to commodities or energy is a good place to be moving forward here. I like large cap ETFs. One specifically I have a large investment in is JEPI, Equity Premium Income. It pays a monthly dividend. The dividend is a hedge. At least you have the opportunity to maybe make some cash if the market continues, if it does go higher. And I don't think central banks are done.
I would say in general, the small cap Explorcos and the developers are trading at extremely low valuation. I'm talking about that kind of $500 million to $200 million, $50 million to $200 million market cap company. They're trading at record low valuations. The large cap producers are generating record free cash flow. Their stock prices are starting to work really well. I expect a big M&A cycle in the next 2 years in the sector. And these names are trading at rock bottom values with also the increasing gold and silver price. They can see multiple expansion as well as M&A activity, which should light a fire under the sector. So those smaller names that have been left for dead should do quite well in 2023.
I'm pleasantly surprised at the resilience of the U.S. economy. The pace of interest rate rises that we have withstood with the relative lack of pain in the economy. By the way, I'm not saying that nobody has felt pain, but the relative lack of pain that we felt in the economy has amazed me. And in the near term, I would suggest that I'm bullish on the broad economy and equities, both because we've been able to withstand the pain, but also because there are literally trillions of dollars sitting on the sidelines. Investors are really, really, really cashed up. Before I come away as too bullish, however, I would suggest to your listeners that the effects of interest rate rises often lag, which is to say, as an example, the doubling of the 30-year mortgage rate has resulted in a slowdown in single-family residential sales. But we haven't seen wholesale price declines because people haven't been willing to lower the ask prices. What we've seen is a sort of a hiatus in transactions. And my guess is that as the impact of higher interest rates gets felt through the economy, that the reaction of the economy, that is the negative reaction of the economy, will start to pick up. I also would caution investors to understand that increasing interest rates are very bad for the long bond market and can be bad for the equities markets too. Bad in the sense that companies' costs of capital go up at the same time that the capitalized value of distributions, that is, the competitiveness of dividends relative to other savings products, declines. I am amazed, really, at the resilience of the U.S. economy, but I remain very, very cautious in the face of higher interest rates.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.